What is going on, y'all? This is Pay Me in Dividends, and today is December 12th, 2024. There's a couple things I want to go over on this video, but before we get into it, let's just do a quick review on my portfolio. I'm currently sitting at $89,010. My holdings have not changed since my last video. I still have 1,000 shares of AIPI and 1,000 shares of MSTY. But what I want to talk about today is why I choose to invest in dividend ETFs, more specifically high yield ETFs, over single stocks, right? So there's a couple things I want to cover, right? First is diversification. High yield dividend ETFs invest in a broad range of dividend paying companies via an index, which will help spread your risk, right? So you have these income ETFs that will track the S&P 500 or the NASDAQ, and they will perform options on these indexes and pay you out the premium as a form of a dividend, or the underlying may be a single company. However, it's not just reliant on the performance of the company per se, because as long as that company is volatile, right, like a MicroStrategy, they're still able to extract premium out of that out of those options and pay you out a dividend. So that is the first reason why I like this style of investing. Also, time management, right? Researching and monitoring individual stocks can require a lot of time and commitment. So unless you're very passionate about the stock market, then this isn't going to last very long, right? You may get excited by a few stocks that may be rallying during that period of time, but then you kind of lose your focus and get off of your game plan, or maybe you didn't lock into a particular strategy, and so your focus is constantly shifting from what's new and what's trending, and you never really prioritize a particular strategy, which long term is what's really going to grow your portfolio and really going to increase your investments over a 10, 20, 30 year period. Because you got to remember, we're in this for the long term. This is a long-term game. This is not a get rich quick scheme. This is long term. So that's another reason why I choose to invest in dividend ETFs over single stocks. Now, a couple things I want to go over as well is the fact that there are no dividend cuts, right? Because these ETFs were created to generate income regardless of the market conditions. That is their sole purpose, is to generate income. It is true that most of them will not grow as rapidly as the S&P 500 or the NASDAQ, but their sole purpose is to generate income. And we can see how this played out during the pandemic, right? So the first example I want to show you guys is VOO. So VOO is an ETF that tracks the S&P 500. And if we look at the data on this website, we can see that in 2022, the S&P 500 ended the year negative 18%, right? That is the S&P 500. Now, an ETF like VOO only paid a 1.21% dividend. So you only earned a 1.12% annual dividend, while also your holding decreased by 18%, assuming that you held it the entire year and you held that position in VOO that entire year. You were down with the market, right? Now, if we look at an income ETF like JEPI from JP Morgan, which I've covered in a previous video, we can see in 2022 total return, meaning including the dividend, yes, it was still down, but it was only down negative 3% compared to the S&P that was down almost 20% and only yielded a 1.21% dividend yield, whereas JEPI actually paid you 7.11%, right? 7% dividend yield. And so total return, you were only down negative 3%. Now, of course, it still wasn't a positive return, but it still technically outperformed the S&P. And the major reason why it did is because JEPI was still able to extract premium from performing options on your behalf and then paying you out the dividend. And so then you had the option to reinvest that money and put it back into the market, or you just had cash flow in your pocket as opposed to VOO, where you only receive 1.21%, right? You would need millions of dollars for this to even be relevant. So those are just two examples, just a quick example. Of course, across the board, there are definitely high yield ETFs that underperformed VOO during 2022, but there were a handful that outperformed if we're just looking at total return. And when I say total return, I mean the performance of the actual share price along with the dividends that were received. So that's just another reason why I choose to invest with this strategy. Now, another thing, right? So we were talking about single stocks, why I typically don't invest in single stocks, right? Here's the thing, even income ETFs that are based on one company still have several methods of generating income through option strategies, right? So here's a couple examples. These are some yield max funds, these first two, and these two are from Curve ETFs. Now we know that MSTY pays over 100% dividend. NVDY, which is a NVIDIA based option strategy, pays close to 100%. I believe it's around 60% right now, but it's a very high yield dividend. And TSLP is from Curve. That's a Tesla option ETF. And this AMZP is an Amazon option ETF. And so although these ETFs are single stocks, right? So it kind of contradicts what I originally said. However, there's still several methods that these ETF managers have to create income, even if the stock itself is down. And if you look at MicroStrategy, NVIDIA, Tesla, and Amazon, most of these companies don't even pay a dividend because they are high growth companies, right? High growth tech companies that are reinvesting their dividends into the company to become more profitable. And if they do pay a dividend, it's no more than 1%, right? So if your stock is going down the entire year, you're not even receiving any cash flow in the meantime in order to compensate and to hold you over while you hold this stock. Now, this is by no means saying that these stocks are not worth holding. Obviously, NVIDIA has performed great. MicroStrategy has performed great because of its correlation with Bitcoin and all of the Bitcoin that Michael Saylor has purchased through MicroStrategy. Tesla net margin is constantly increasing, and Amazon, we all know they are the biggest delivery service in the world. So these are great companies, and by no means am I saying that they are bad investments. But what I am saying is if you don't want to perform options on these companies yourself, this is just another strategy that you can implement in your portfolio to generate constant cash flow, even when the underlying stock may not be performing well at the current moment, right? So the next thing I want to get into is dividend cuts, right? So if we remember during the pandemic, there were a lot of big names that cut dividends or suspended their dividends. Companies that we did not think would suspend their dividends, right? And so if we go down here, we can see that American Airlines in 2020, they suspended their dividends. So did Boeing. So did Expedia. So did Disney, right? These are all big names, and these are just 4 companies that I'm using as an example, but there were a handful of really big companies that you never would have expected to suspend their dividend, but they did, right? And not only did they suspend their dividend, but most of these companies' share price went down tremendously during that time again. So again, you were not even compensated with income while holding this stock. Not only did your stock decrease in price, but you didn't even make any cash flow during it, right? And the whole point of this strategy of investing is to create cash flow. And so here are just a couple examples of ETFs that paid during the pandemic and did not suspend their dividend, right? So we have JEPI from JP Morgan, we have QYLD, we have BST, which is a closed-end fund. It's not an ETF, it's a closed-end fund, which we can get more into in another video. But this is from BlackRock, and they kept their dividend consistent till this day. We also have SCHD, which is a Schwab dividend ETF. We have VIG from Vanguard, and we have DIVO. And I also included USOI from Credit Suisse, I believe is how you say it. Now, this is by no means not a great investment. I would never put my money into this stock, but they still did not cut their dividend, right? They didn't suspend their dividend. Again, I'm not endorsing this stock at all. I would never invest in it, but it's just another example that even if your dividend ETF is performing horribly on the chart, you're still going to make cash flow, right? You're still going to generate income. And so those were just a few examples and a few reasons why I invest the way I invest, right? Now, a couple more interesting things that I found online was this article from Investopedia. Now, this is more a take on dividend growth stocks, kind of like MasterCard, Visa, Coca-Cola, Procter & Gamble, Johnson & Johnson, these kind of stocks. So this isn't too relevant to high yield dividends, but one part that did stick out to me was here, right? Even during periods of recession, dividend stocks have historically shown growth. 75% of the returns from the S&P 500 from 1980 to 2019 came from dividends. So that alone just shows you how important and how relevant dividends are in the market. Now, again, these high yield dividend ETFs use unique strategies, right? They perform covered calls, or sometimes they'll do synthetic options where they don't actually hold the shares. But it just shows you that there are so many ways to make money in the market. It's not only the traditional buy and hold, which I do encourage, right? In my retirement account, I hold the S&P, I hold the NASDAQ, and that will sit in there long term, and I will dollar cost average into that. But for my regular taxable brokerage account, my entire goal, my entire philosophy is to create and generate as much cash flow as possible so that I do not have to work a day job for the rest of my life. Or if I do choose to continue to work a 9-to-5, I can at least have the peace of mind to know that I have another source of income outside of my 9-to-5. And so that gives you peace of mind, that gives you options, that gives you flexibility, right? And so that's pretty much what I wanted to cover in this video. One more thing before we get out of here. This was a good interview by Passive Income Investing, and this is a very good book, and I actually ordered this book a few months ago and read it, and it's very, very interesting. It's called The Income Factory by Stephen Bavaria. And this gentleman pretty much broke down how you can almost force growth in your portfolio with dividend stocks. Now, he is more into closed-end funds, which I'm not invested into because I still don't completely understand how they operate. But there are a lot of good ones out there, and I'm doing more research on them. And I'm sure at some point I will add some closed-end funds to my portfolio. And his strategy and his philosophy aligns with mine. And it makes sense the way he breaks it down, how you can almost force growth in your portfolio regardless of what the market is doing, because as long as you're receiving cash flow and reinvesting that back into the portfolio, maybe building new positions with that income or beefing up your current positions, but regardless, over the long run, you can force growth, and at any time if you need to access cash, you don't need to sell your shares. Right? Just imagine all of the people who are about to retire in 2020 when the pandemic happened, and their 401ks or their IRAs or their taxable brokerage accounts dipped and pulled back tremendously, although the S&P did regain itself shortly after. But for the people who might have been scared or panicked, right, and they sold out of fear, what if they had held dividend ETFs, right? What if they had held closed-end funds, these income generating funds, and instead of worrying about their portfolio value decreasing momentarily, they could still have peace of mind because they have that passive income that is being generated by their assets. And so these are just a few reasons as to why I invest the way I do, why I choose to invest in dividend ETFs over single stocks, more specifically high yield dividends over single stocks. And so, you guys let me know what you think in the comments. Let me know if you agree, if you disagree. If you have any ETFs that you would like me to cover, or anything that I should put on my watch list. And before I get out of here, I just want to thank you guys again. I'm at 353 subscribers. It's like every day I wake up, I have more subscribers. It's very motivating, and I'm really trying to be creative with this channel. And so let me know your thoughts in the comments. Let me know what you want me to cover. Give me some ideas. Let me know what you're invested in. I'm really fascinated in what other people have their money invested in and what's working for them. So again, thank you guys. I appreciate you guys checking me out, and I will catch y'all in the next video.